Okay, good morning. So today we're going to talk about one key tip for investment safety. And what this is the type of either mutual fund or exchange traded fund that you're invested in. So most people or most investors put some of their money in some sort of a mutual fund or exchange traded fund, an ETF. And ETFs and mutual funds will invest their money in a portfolio of assets, so many different stocks and bonds, and it achieves a certain level of risk for you, the investor, in order to hit your financial goals. Now, what's really important to understand is there's a difference. Not all ETFs are created equal. And there is what's known as a physical ETF, and then there's also what's known as a swap ETF. A physical ETF physically owns shares of the stock in the portfolio of companies that you may be invested in. Whereas a swap ETF tries to mirror an index or mirror some sort of portfolio. And it doesn't necessarily own the shares of those stock or bonds themselves. It's important to understand this because there's advantages and disadvantages to both. Really, having a physical ETF is safer, but a swap ETF might have some sort of tax advantages. The reason that I bring this up is because a lot of people don't even know this, and it's important to know what you're invested in. And owning a physical ETF, one that actually owns the shares physically, is safer for you as an investor than owning a swap, because a swap might trade some sort of a derivative in order to achieve that goal, but it doesn't actually own the shares, and so there's counterparty risk. That means that there are other parties involved that might not be able to fulfill their contractual obligations. And when you do that, you're taking on risk you might not even be aware of. Please post a question or a comment. Send me a private message if you want to talk about it privately. I know this is a little bit more complicated topic, so it's always good to see your particular questions. And until next time, I wish you unlimited success.